Good morning, everyone. Thank you for joining us. We have one of our largest attendee lists ever. I think we have over 800 investor partners and prospective investors, and just people that are interested in learning about real estate and what Origin thinks. And it's part of our mission at Origin, actually, is to help educate investors about what we think in the market, best practice, kind of across the board. So this is another live actualization of what we believe, which is we want to help educate you. My name is David Shear. I'm co-CEO and co-founder of Origin Investments. I'm joined today by Phil Schuholtz, who's been here for, I believe, almost 6.5 years, graduated from Wharton, worked prior to a competitor, but initially here as an analyst and now as heading our Dallas office and our Texas acquisitions. And also by Ryan Brown, who has worked at Origin for 3 years. He's our head of data analysis, actually declined a Rhodes Scholarship in order to come work with us, which I'm so grateful for, and really excited to have both Phil and Ryan present on what I think is one of the more compelling things we're doing at Origin. And I'll circle back onto why, but this is something we've invested in over for 3 years, and we are committed to continue to invest into the future. I do have to, next slide, please, or I guess first slide, please. I have to start doing these disclaimers. We're going to have to do this on all webinars. We're getting a lot bigger as a company, and that comes with scrutinization. So we've always been transparent, and we want to continue to be transparent, but there are limitations now. So there are certain things we won't be able to share, but mostly we will, and we're committed to it. Please read this if you want to understand it in detail. Next slide, please. So a couple of housekeeping before I jump into this. We're going to try to have a presentation for about 35 minutes. Lots of Q&A afterwards. We'll try to answer every question. We had a lot of questions emailed in prior. I have those. I'll leave that process at the end. I'll speak briefly, and then I'm going to hand it over to Ryan, and then Phil is going to conclude the presentation, and then I'll lead Q&A. Please use the Q&A box, not the chat. It just helps me organize and make sure that I see your questions. So use the Q&A feature. And I think that's it. So a little bit about Origin. What I can tell you under the new rules and regulations, we have 1.4 million in equity under management. We do really 3 different strategies at Origin. One is equity investments. That's both in development and direct real estate. We also lend. Also to multifamily. We're solely focused in that asset class, but we are a lender to multifamily and preferred equity and in K-series bonds. And then we also own and operate multifamily. I would tell you in our markets, which are the Southeast, Texas, and Southwest, we're one of the largest multifamily owner-operator developers in the country at this point, and certainly one of the most active. Alignment has been it's been a theme that sort of resonated throughout our investor partners, throughout our firm history. We were formed about 14 years ago, and through that period of time, my partner, Michael Episcope, and I have invested 75 million of our own equity into our funds and deals. We do this because we formed Origin to protect and grow our own capital. And we feel like it's the best place to do both. And so we've continued to do that. Our returns, which I really can't speak to because of these new regulatory constraints, but I can speak to the returns that we've actualized. So our first 3 funds, Fund 1, 2, and 3, placed us in the top decile, and in fact, much higher than that. So meaning, if you compare us to other managers who do the same things we do, who invested at the same times we did, we tend to be the best of the best. And there's a lot of reasons for that. And one of them today we're going to talk about is decision making. And decision making really starts with being able to have a firm grasp of where you think rents are going to be in the future. That's a very, very important variable. So it's something we spend a lot of time on, and that segues into my first slide. So this entire webinar is on Multilytics. That's what we've created and trademarked as our rent predictive analytic machine learning platform. And so why did we build this? And why was Ryan hired to do this 3 years ago? And why have we continued to hire others to help him on his team? It's because what existed in the market did not fulfill the needs that we had. And we tried. We tried to utilize other software and we found real problems. The first of which is sort of the most important is we found that their predictions on rent growth weren't accurate. They were at best right some of the time and wrong some of the time. And you sort of were left wondering, maybe it'd just be better if I just use the historical average, which is plus or minus 3% for the last 50 to 100 years. Maybe we should just always use 3. You're wrong, but you're accurate and consistent, at least not accurate, but you're consistent. So number one, it wasn't accurate. You were paying for something that didn't really produce the accuracy you needed. The second was granularity. And what I mean by that is the other rent predictive analytic softwares that you can license, they didn't go down to the property level. In fact, they really didn't go even down to the neighborhood level. They went down to the zip code level. But zip codes are really large, and zip codes can be very different if they're bifurcated by a rail line or a highway. Neighborhoods can be very different within one zip code. I think you can relate to that even in the cities you are. A lot of us are in Chicago, for example. In Chicago, you might have a zip code that picks up on Fulton Market, which is the hottest area of Chicago. But also if you head west, it picks up on, Damon and what's west of Damon. And that's a, gentrifying neighborhood. Consistency. And by the way, Ryan will get into this, but our rent predictive Multilytics machine learning doesn't even go down to the neighborhood level. It goes down to the property level. So you can assess where rents are at an actual address. Consistency was a huge pain point. The models we were using, the licensing, the software that we were licensing, they would constantly change their predictions. And so, for example, 3 years ago in Texas, they were predicting on average 2 to 4% rent growth. And then a month later, they changed it to 1%. Well, no deal works at 1%. And why did they change that? And then 6 months later, they changed it back to 3. You can't run a business like that. You have to be more accountable to your predictions. And that segues into the last, which is accountability. We back test Multilytics predictions. We'll get into that and how accurate it's been. We publish, and this is really what this report is about, what we think our predictions are going to be so that we're accountable. The market leaders in this space don't do that at all. They never publish what they predicted. In fact, they're constantly changing it. And there's no accountability what they do. We will be the opposite. We will be 100% accountable, much as our annual real estate trend article that we write. We then come back the next year. We've done this for the past 3 years, and we grade our predictions and we make new predictions. That's accountability. We'll be the same with Multilytics. And before I hand it over to Ryan to talk about not just that this is better software, but why? Why is it so much better? I do want to talk a little bit about how different our predictions are, because it's really important. What we're about to share today is that we're predicting negative rent growth for a 12-month period in multifamily on average in every market, every city, every submarket in the country. Because I get this a lot. Well, that's great, Dave, but what about Austin? No, it's negative in Austin. No, but what about Nashville? Nashville's hot. No, it's going to be negative in Nashville. And so the scope is everywhere. We think it's going to be negative, and no one else is predicting this. And to give you an idea of how much we're stepping out, this has happened 3 times in the last 100 years. 3 times in the last 100 years. One was the Spanish flu, one was the Great Depression, one was the GFC, the Great Financial Crisis in '08. We think it's going to happen again. We're going to explain why. I'm also going to explain why it's not as bad as you think, because we also believe we're going to come out of it relatively quickly. And what you should also think about is, think about what I just said. It's happened 3 times in 100 years that rents have averaged negative. That's pretty incredible, actually. And it speaks to the strength of multifamily housing and why we're so excited about it as a long-term asset class. This is a necessity item. We're a growing population country. We're underhoused. It shouldn't surprise you that this almost never happens, but we believe it's about to happen. So with that, I'm going to hand it over to Ryan, and he will go over why the model works, what's different about it, and then I'll hand it to Phil, and he'll get more into the data. I will tell you that the full report is going to be released on Friday. Everyone who registered will get the full report along with the reporting, and we'll go much deeper into each city in the report. But this presentation will start to get you an indication of where we're heading. So with that, Ryan, please.
Thank you, Dave, and thank you all for joining. It is surreal to present to you all. I would have never imagined Multilytics would grow into what it is today. That said, what is Multilytics? In truth, it's an umbrella term for many models and data streams used together as a tool for investment decision-making. It's not an oracle. This is to say, like any other model, it's fallible. On today's webinar, we are focused on market forecasts derived by Multilytics, but to be frank, the actual value, as Dave alluded to earlier, comes from the more granular forecasts it can make. This is especially relevant to Origin, as multifamily rent growth in a given neighborhood for a Class A multifamily property can be very different from a market average or an average across all asset classes in a given year or 10 years. This is to say that third-party forecasts could provide perfect forecasts with such granularities like zip codes, and those forecasts would still not be helpful in our view. Of course, Multilytics is not constrained only to making forecasts. For example, we have models that estimate what the starting rents for a given development might be, and others that estimate where rents can be after a certain amount of renovations. But again, today's webinar is focused entirely on our rent growth forecasts. So with that, next slide, please. So I want to harp on what kind of separates us from the industry, and that is, again, how granular we can go. And I think this video on the left here is going to be helpful at summarizing some of the points I'm going to try to make. So please press play. Here we see the average year-over-year growth for 100-meter by 100-meter artificial submarkets in Harris County, Texas. A quick caveat here is that this visualization averages together different asset classes. Still, it's a valuable demonstration of my earlier point that rent growth does not move in groups of zip codes. So here you can see this significant heterogeneity between different areas, even nearby one another. Our model not only understands that heterogeneity, but understands rent in a given area relative to others. So if you're in neighborhood A, maybe you can't afford it, and move to neighborhood B. That type of relationship is important to understand when forecasting rent growth, and is completely ignored by industry-leading models which look at zip codes in isolation. This is not true for Multilytics. And this is the main reason, in our view, or one of the main reasons, that our model outperforms alternative solutions. For instance, we scaled up our model to the leading provider submarkets and made predictions so we could compare apples to apples. And this was in 2021. We wanted to understand which approach would better estimate if a given area will achieve greater than or less than 3% rent growth, as this tends to move the needle on investments. And at the start of 2021, the leading group predicted that nearly the entire country would have flat to negative rent growth, while our model appeared to misspecify to us, forecasting rent growth well above 10% and 30% in certain areas. And this seemed crazy to us at the time. At the end of the study, though, we found out that our approach had correctly classified 95% of submarkets and apartments to the industry's 4%, or the industry leader's 4%. Of course, we backtested our models too and found the annual median absolute error is about $15, but of course this varies by location. And when we use our forecast internally, deal officers are equipped with precise backtest details for their area of interest. So for any given apartment, they know exactly how accurate the model's been in the past 10 years. Fun fact, by the way, Midland, Texas is incredibly tough to forecast. That is by far the hardest market, and then maybe because it's tied to oil. Next slide, please. We also continue to evaluate our method internally, and we review our forecasting errors constantly. This chart is our accuracy this past year compared to the leading provider in Charlotte. The point of this slide is to say we are continually evaluating our method and alternative approaches. Please do not mistake this as a claim that we will always be this accurate in Charlotte or other markets. This market environment is incredibly complex, and the past performance does not guarantee future results. Incidentally, we reviewed this chart and many others like it a couple of weeks ago internally for markets and submarkets we made a forecast for a year ago. But I only have so much time to speak to you all, so we chose a market that falls in the middle in terms of performance for both the leading group and Multilytics. And in the article later this month, we'll share results across the board. You may accuse me of cherry picking, one our competitors did poorly in, but unfortunately, as I said earlier, this is about average performance for both methods this past year. So on average, the market leader would have been off by a little over $100. For Origin internally, the data science team sends clear-cut forecasts a year in advance to review with the group and saves down the latest estimates from the leading providers. So there are no post-hoc adjustments when we review accuracy, as there is in this chart, and then a year from now, we will not be changing any of the forecasts we showed you today. They remain consistent over time. At this stage, many of you may wonder how Multilytics forecasts work or what features drive them. A technically precise answer would take much longer than we have on this webinar, and it took several months to put together in a thesis. That said, rent affordability ratios and our proprietary measure of supply are generally the most significant drivers along with income and job growth. I cannot provide an exact weighting for each feature as it varies by location. For instance, what may drive rent growth in Manhattan may not be measurably the same as in Midland, Texas. Thus, we do not force universal weightings or frankly, even the same features by location. Generally, we have the model search for the most predictive set, giving some basic ground rules. And again, we are looking at relations between areas which leading models ignore, and this in part drives higher accuracy, especially when we break down to property specific or submarket forecasts. As it relates to data sources, we have a bevy of third-party private data sources and public data sources, but incidentally, some of the most useful data comes from the Census Bureau and the Bureau of Labor and Statistics. That said, we ensure market officers know what Multilytics predicts rent growth will be for their markets, submarkets, and properties, and how it got there. And because of that, I will now hand it over to Phil to cover some forecasts for this year. Thank you all for your time.
Thank you, Ryan. That was quite the overview. Still learning how to code a little, but we'll make sure I get to your level here soon. Before diving in too far on the forecast for the gateway markets, I want to ensure we understand what these charts are telling us. On the left-hand side, we see the median rental rate for our gateway markets according to our proprietary Multilytics index. The gray line that you see represents the latest data as a predicted range of our forecasts 6 and 12 months from now. The second plot on the right shows year-over-year rents. As you can see, it's the same forecast, but in year-over-year terms, we can see that across the gateway, and frankly, most, not all of our markets, we expect to see a continued decline year-over-year of deceleration, which ends with us achieving true negative year-over-year rent growth in most cases well before December. And then promptly thereafter, as you can see on the chart on the right, we see that year-over-year rate, comes back and rental rates will increase across the gateway markets and for all of our markets for that sake. And we'll get into some more granularity here in a second on our market specifically. So this translates into essentially what we're saying is positive month-over-month rent growth starting from February to July. So we continue to see that and we'll continue to monitor that into the summer. But a record amount, I'm sure, as many of you read from headline reports, is coming online here in the second half of the year. Essentially, 1 million units are anticipated to essentially enter all of our markets across the United States, which goes back to the most supply we have seen on record since 1970s. By the end of the year, with rents lower than we start, we simply are going to forecast relatively weak spring and summer, given the leasing and occupancy, with an abysmal fall and winter thereafter. We will carefully keep continuing to monitor this rental data to make sure that what we are seeing occurs, and essentially that no movements are too surprising. In fact, looking back, Multilytics suggested that 2023 would be a rough year, and we were forecasting this in 2021. That said, if you see negative rent growth between today and May, our forecast would have been too bullish, implying the market deteriorated faster than what we're currently anticipating. If this is the case in a few months, we'll provide an update in another webinar and give essentially new forecasts based on this deterioration. However, preliminary data suggests that we are on track for the base case, which, again, I should mention is far more bearish than all third-party forecasts, which we've seen some calling for 8% plus, especially in Austin. With that out of the way, looking at the gateway market specifically, we say rent growth falling either flat or down about 2% on a year-over-year basis, which is most likely being rent growth about -1 by the end of 2023. As I mentioned before, you still have positive growth before today in the summer, but this is quickly removed as the confluence of headwinds begin to pick up. New units fighting for occupancy later this year, worsening economic conditions, and so on. Notably, this is not as negative as some of our markets, but it's important to keep things in context that gateway markets have seen about half the cumulative growth since 2020, as places like Phoenix or Nashville, and even Tampa, who never saw negative rent growth in 2020. Moreover, we do not see gateway markets having a swift or strong recovery, with much growth post whatever event is to come down the road, driven by high absorption, which generally speaking occurs alongside tremendous population growth. And we'll touch on more of our long-term outlook in a couple of slides. With that, can we please move to the next slide? All right, so on this slide, we're looking at more of our target markets on a year-over-year basis from July 2023 and January 2023. So in Austin, we're saying year-over-year rates will be about 1% in July and about -2 in January. And again, I just want to reiterate, this is on a year-over-year basis. We have a report coming out soon, as Dave mentioned earlier, that these forecasts in more precise terms and some general commentary to back up the claims. The charts will look similar to what you see now for the gateway markets. We'll be grading this report throughout the year. However, the main takeaway here is we see negative rent growth across many of these markets, and now is not the time to be underwriting aggressive short-term mark-to-market or rental growth. For instance, for Class A urban Austin, we have seen rents falling by at least 5% year-over-year basis. And while we could be wrong, I would urge any investor on this call who is justifying their assumptions using a third-party rent growth forecast to look back at how well such predictions have done and to not too distant past. And also pressure underwriters that you're looking at future deals to relay what rent growth they're using, as Dave mentioned earlier, is a very critical assumption in a model. That said, it's not all doom and gloom. We see light at the end of the tunnel. For example, for the same submarket I mentioned, Austin, the compound annual growth rate for the next 5 years is 2.7%, with about 3.5% rent growth in 2024, followed by almost 8% rent growth in 2025. Can you go to the next slide, please? So assuming we see a drop in 2024, which you'll see on this chart, we can see that in 2023, by the end of the year, most market, as we said, every market will see negative rent growth occur by the end of the year. So what's that mean looking forward? As you can see in the 2024 column, we expect a pretty strong recovery in most of our markets to make up those lost rents that we're going to see in 2023. This is in part because as the markets absorb new supply, we see that the relative essentially dearth of the new units follows it. Many markets have sufficient population growth that's coming to the markets we invest in at Origin, and income growth over the next 5 years, which, as Ryan alluded to earlier, are some of the strongest factors that essentially outperform other markets. We believe with such markets that we invest will, continue this trend, not just over the next 5 years, but really the long, term as population keeps coming to the South. But of course, there's no significant variation with markets. And there are, for examples on this chart that you'll see, for example, Denver at the bottom compared to Austin at the top. Just because we are forecasting Denver lower as a market, it's always important to remember that there are sub-markets and properties within each market that can vastly outperform other sub-markets and markets in other markets. So with that, I will kick it back over to Dave, who will jump into some Q&A for us.
Thanks, Phil. And I see that I'll lead Q&A. I see that there's some questions streaming in. I do want to address it really quick, and please send your questions in. I'm seeing they're coming into both. Send them into the Q&A, but I'll find them either way. Question for Ryan, because I think you covered this, but I want to cover it in more detail. This was emailed in prior. How accurate have Origin's Multilytics models been in the past in their predictions of future rent?
So we see a median average annual error of about $15. So when we make a forecast, generally we fall within $15. Of course, in 2020, we didn't do as well because you can't predict something like COVID, so we didn't include that in our $15 score.
But when you say $15, do you mean over a 1 year period, 2 year period, 3 year period? What does that mean?
That stacks over a 5 year period. So within 5 years, we hope to be within $15 based on our historical accuracy.
And how would you contrast that to what you can license? You can't license Origin's Multilytics. It's our proprietary software, but some of the market leaders, like where would they be in accuracy?
They do not.
Over a 5 year period.
They do not provide their own back tests, so I can't say over a 5 year period, but since we've been back testing them ourselves since 2020, and by that I mean we've saved down their forecasts and graded them a year later, they've tended to be off by $100 to $200 a year. And they change their forecast by about 5% or more each year as well.
Right. So the answer is, for them, it's hard because they're not accountable. They don't do the same things we do. But if I just take the midpoint of what you said, if we're $15 and they're $100 to $200, so just say $150, it sounds to me like they're 10 times less accurate. Is that the math?
That's one way to look at it, yes.
Yeah. And we like to state things in ranges because it's not 10, maybe it's 6 to 10, who knows? But the bottom line is they're a hell of a lot less accurate. And that's the problem. Now, let's transition into the why, because you said it once, but this is complicated and it's hard to process. Why are we so much more accurate? What are the leading softwares not doing that produce their lack of accuracy? And by contrast, why are we so accurate?
I think one of the main reasons we're more accurate or have been more accurate than leading forecasting groups is that we do not view rent growth in isolation. So, for example, they will look at one zip code in Chicago in isolation from the rest of the country and not see what's happening around it. Whereas our model will look at individual, properties in very granular neighborhoods and see how they relate to one another. This is important because that's how rent really works in my view. If you can't afford to live in neighborhood A because it's a bit too pricey, but you still want to live near downtown Chicago, maybe you look somewhere in the River North. If you ignore those relations, you're missing out on a lot of what actually drives rent growth. And this, in my opinion, leads to spurious or misleading forecasts.
Yeah, I couldn't agree more. A renter is looking at, everyone wants to rent in the nicest neighborhood, in the nicest building, in the largest unit. That's your matrix that you've set up in your mind, but then life intervenes and you actually can't afford the nicest neighborhood, largest unit, nicest building. So then you start to look at the second nicest neighborhood and the medium unit, et cetera, et cetera, et cetera. That interrelationship is in our world, spatial analytics. This is what Ryan majored in. This is what Ryan wrote his thesis on. There's not a lot of places in the world doing it at all. U Chicago is one. That's where a lot of the leaders in the space are. Those professors were trained. Our IP, our technology, in my opinion, is the leader in the space for that reason. We have integrated a unique approach. No one else has it. And there's a real barrier to entry. You can get there, but you have to have the knowledge and you have to write hundreds of thousands of lines of code, which takes time. How long? Years. Okay, so I'm going to move to Phil. Do you want to add to that?
Yeah, I mean, Dave, you hit the nail on the head there. But I'd also say what's interesting is we got to this place with a lot of input from the boots on the ground approach that you referenced earlier, whether it was Tom, Bryony out in Denver, Dave Welk in Charlotte, Kyle in Nashville, and myself here in Texas. Really putting a model with the human element really goes a long way.
Yeah, I'm gonna move to the live. So this first, I'm sorry, I don't see the name. It's GA, but thank you for the chat. This is a question for Ryan. Actually, it's more of a question for me. Ryan, you answered this already. David, have you considered licensing your model? We have, honestly, but right now it's so central to our own decision making. And to be clear, it doesn't make decisions for us. It's a tool, much as having our acquisition officers like Phil. He lives in Dallas. There's a huge advantage to Phil living in Dallas. He has a feel of a living, breathing, evolving city that you wouldn't have if you didn't live there. But that's true of our people in Nashville and Charlotte, Denver, et cetera. And so this is a tool, but it's really powerful tool. And the reason we pay attention to it so closely is it's been so accurate. And not only has it been so accurate, but it's been so accurate in the most volatile rent growth movements we've ever seen. So it'd be one thing if I said Multilytics has been really accurate and it predicted 3.5% rent growth, and it really, it was 3.4, and if I was wrong, it was 3.1. That's small ball. That's usually how real estate is. But COVID created these distortions, not just interest rate distortions, but population movement within the US, right? People didn't have to work anymore in New York. So where did they move? And, it really accelerated these distortions of, housing is underhoused in certain areas and overhoused in certain areas. And within that spectrum, it still was incredibly accurate. And that's why we pay so much attention to it. When Ryan came to us in early 2021 and said, look, this is predicting 15 to 20% rent growth, and it's even more powerful at the local level or the address level, and it's predicting in certain submarkets, for example, in Phoenix, 30% rent growth. He was afraid to show it. He didn't want to share it because think about what he's sharing. Rent growth is usually 3%. This is brand new IP, and she's showing Michael and I and the team, hey, this is 25% rent growth. I mean, Ryan, do you want to speak to that? I mean, you kept trying to retouch the model, correct?
Yeah, I mean, when you see it spit out something like 25% rent growth, and rent growth is historically 3%, your first thought isn't, oh, this is right. You're like, or at least for me, I was like, oh, I must have messed up somewhere. My back testing is wrong. But we checked everything. It looked stable, and in the end, that's what we had as our forecast. And to my surprise, and it ended up being right. So
it's been very accurate, even in this very interesting period of time that I've never seen. I've been doing this 15 years. I've never seen like it, meaning the environment, and it was accurate in that environment. So to answer your question, we've talked about it, but it's very central to our decision making, and it's a competitive advantage. So we're very happy having it in-house. In terms of next question, and Ryan or Phil, either one of you can take this. I believe this is from Jesse. Thank you for this question. What is it measuring in terms of the class? Is it class A, B, C? And I know the answer, but please, one of you take it.
Yeah, Ryan, I can take it if you want to add any context, but we measure all classes to start with, but given our primary business as an institutional owner is mostly Class A, and what we do, that's what our models are more trained on, is Class A. Again, given that's what Origin invests in, we're not investing in Class C properties, but it does matter that we do capture Class C, obviously, because that's an apartment that someone's going to rent. So it matters in the ecosystem. But yeah, we're primarily focused on the Class A component.
Yeah, I agree. From a spatial analytics standpoint, the Class C could pick up if it's in a great neighborhood. It's back to trade-offs, right? You could also argue a great address never is Class C as well. The next question, Greg, thanks for your question. This is a question about Denver. Why is the long-term CAGR so low relative to other markets? Does someone want to take that?
Ron, you want to take the quick answer on that one?
Sure. First, I just want to caveat my answer with there are pockets of Denver Multilytics really likes, so don't read too much into a market average. That said, relative to most markets Origin looks at, we don't think it will have the same tailwinds pushing it towards higher rent growth, and that includes things like population growth relative to new supply. So for all the new supply coming online, you need a decent amount of population growth to absorb it, which enables higher rent growth. And we don't know that that will be the case for Denver on average. But again, in certain markets, that may not be true.
So Jeffrey, thank you for your question. I'll handle this one. So based on negative rent growth, is Origin sitting on the sidelines while markets catch up, or are you pinpointing investments? He mentions gateway markets. So a couple things, Jeffrey. Number one, we don't invest in gateway markets. So, we believe that because we have people that have lived in their markets for 5 or longer years, and we're experts in these markets, and we're well known in these markets, and we get amazing deal flow. Like we want to really stick to our knitting. We're in 12 or 13 cities, and we tend to have people who live there. So we don't chase new markets. It takes a long time. So no to gateways for that reason. We also believe that long-term CAGRs are longer in our growth markets, or larger, sorry, in our growth markets and gateways. The question about Origin sitting on the sidelines while markets catch up, we have been sitting on the sidelines, actually. We haven't bought a direct building, meaning a built, stabilized building, in over 3 years. So it's been a long time since we participated in the direct acquisition of properties. So I say this a lot on webinars, follow our actions, not our voice. I can show you through actions, like we've been on the sidelines, but it doesn't mean that we're not participating. It just means we participate differently. So we've chosen to develop instead of buying occupied cash flowing buildings because we believe that we're really good at executing the development. In other words, the idiosyncratic variables we believe we can execute. And then the margin has been really, really large, meaning, historically development margins are 25 to 30%. They got as high as 45%, in 21. We really want to be in that space. Now they're sort of back down to 30 to 35%. But still, historically pretty good. And then the other thing that we do is we lend. And so, there's a huge need for lending in the market, and we're able to get in our preferred equity platform, 13 to 14.5% in protected positions. So, maybe we have 25% cushion, 20% cushion, meaning if a property goes down 20 to 25%. We still haven't lost our principal because that's common equity. It's not us. Of course, if the property does exceptionally well, we don't get 30% because you're a lender. You're going to get 13 or 14. That's it. But we believe that that's a very good return in the environment that we see, certainly with negative rent growth in the short term. And the last thing I'd say, Jeffrey, is we believe, and so does Multilytics, that the long-term CAGR, or the long-term rent growth outlook, is actually quite positive. And so when I'm looking at this year, what I'm hoping happens is that a lot of people that didn't make the decisions Origin made, maybe they overpaid in 21, maybe they put on variable interest rates to make it worse, and they might be in a lot of trouble. And so, our job, not that I'm rooting against them, but I'm rooting for us, right? And so if they need help with recapitalization, we can step in. If they can't recapitalize and they lose their property, Origin is exceptionally well positioned to take over those assets and start buying direct stabilized assets. Again, we did it a lot before values got crazy. We can do it again. So I don't know what the future holds, but I would not want to buy direct tomorrow. It's too early. There are other ways to invest. I think by the end of this year, there might be an opportunity to buy direct, and we'll keep people updated. I'm going to move to Q&A. That was the chat. By the way, this is amazing. I mean, Phil and Ryan, I think this is your first webinar, but I will say that every webinar I say, please don't use the chat, and everybody uses the chat. So I'm just going to keep rolling with it. I'm going to stop doing it. Just look at both. So William, first question. Is there a way, I'll answer this because it's very quick. Is there a way to use these forecasts to buy hedges against rent declines in portfolios? William, there's not. There's no way to hedge future rent. The only way you can hedge it is to have an opinion and not buy direct. Like we've done that. We haven't bought an asset in 3 years. That would be the way to do it, or to choose to invest in more protected positions, which we also do. There's no quote hedge for that. There's also no hedge for cap rates either, right? So cap rates are our multiple on earnings. There's no future market of cap rates out there where you say, okay, cap rates were trading a 3.3, and that's essentially a 30 multiple in 2021. I'm going to buy the 3.3 future because I think cap rates are going to 4. That would be an interesting product, but it doesn't exist. I would use it, by the way, if I could. But thanks for your question. So Doug asked a question, are future rates inflation adjusted? And I think what he means is the rent growth of the keggers into the future, are those nominal or real? Maybe you can answer that, Phil.
Yeah, so I'd say we do take into account inflation. Specifically, I think what you'll see in the report that's coming out, you'll see affordability, as Ryan alluded to earlier, something that we track pretty extensively. Obviously, inflation impacts what people can pay as their budgets decrease for rent, which we all know is the largest item in someone's budget. So hopefully that answers the question. So yes, we are taking into account inflation.
Anonymous question, why is Nashville not listed in the long-term growth slide? You can answer this, Phil. I think I know the answer though. Go ahead.
Why Nashville is not in the long-term
in the presentation growth? It probably wasn't on the slide.
Oh, I'm not sure why it's not. We should have it on the slide, but
yeah. It'll be in the report is the answer.
Yeah, it'll be in the report.
So the report you see Friday will include it. Here's a great question for Ryan. Anonymous, can you share an example of a time Multilytics was wrong and what did it miss?
I would actually go back to 2021. So as we mentioned earlier, we did see 15+% rent growth and 25% rent growth even in certain submarkets. But at the end of the year, we ended up being a little bit light. I don't know exactly what we missed. We've done a lot of research into this. I believe the strength and speed of population movements we didn't quite estimate correctly. I think that's somewhat fair, as it was really one of a kind environment. So I think in terms of what we forecasted, that has been the biggest miss. When we look at backtesting data, when we were building the model, one of the harder years to get right was the period between 2016 and 2017. And what was driving that was a lot of regional supply and increasing in certain gateway markets. So we had to come up with a really good measure for supply to improve the model. So that was one of the first things we worked on there.
Thank you. Reed, thank you for your question. I almost missed this one. Are you suggesting we hold off from investing now in REIT type investments? And I don't know if you can clarify, Reed, if you mean public REITs, private REITs. So no, we're not suggesting that because, I'll just make it about public REITs. You don't specify, but public REITs, there's also a price component. And, just as in any stock, you have reality, which is future earnings and net present value of those. And then you have price, right, which is what you pay for those earnings. And REITs are no different. You're looking for the lowest price paid for future growth, and you want to pick high growth and low price. Public REITs, we bought about a month and a half ago for Income Plus, because we believe that the price was very, very low relative to the net present value of their future earnings, and their implicit cap rate was much, much higher than what we saw in the private markets. So now, I said this on our last webinar last week, but since we've purchased our REIT position, the REITs have rallied 10%. So that relationship is much tighter than when we thought there was a lot of value in it. So I'm not necessarily a buyer of public REITs right now, or a seller. It's still mispriced a bit, but not enough, in my opinion, to really want to jump in. But I do believe that that was a good opportunity, and that's been proven out over the last few months. Next question. This is a great question. Does Multilytics only cover Origin's target cities or markets, or does it cover the whole country? Maybe you can answer that, Phil.
Yeah, no, so we built Multilytics essentially in a way that covers every MSA in the country. So we can look at essentially any city. I think we limit it to the top 150 just because some are a little too small to really run forecasts on, but essentially the top 150 MSAs we cover. And I think Dave's even trying to get us to cover Europe, but I'm just kidding.
No. Yeah, it covers the whole country, and it's really important because one of our funds, the Multifamily Credit Fund, is buying B position bonds from Freddie Mac, and those bonds are national, right? So they're loans that are made nationally because Freddie Mac is making loans all over the country. So we leverage Multilytics heavily in our underwriting across the country, and it's a huge tool for that fund. The other part of this question was how do coastal markets compare to the markets we cover over 1, 2, 5 years, et cetera. All that will be in the report because we break this out and include regions, and the coastals are in there. So you'll get that in the report, but thanks for your question. Question for Ryan from William. Thank you for this question. Do you update Multilytics periodically to further improve its accuracy? And why do you refer to this as AI or artificial intelligence?
Thank you, William. To the first part of this question, yes, we look at our residuals and errors over time, and we use these to learn. And if we think we can improve the model, we may adjust it. But anytime we do that, we would then back test it to make sure it did better in the past than what we currently have. And we don't use that to adjust past forecasts. We would only change the next batch of forecasts. So we don't want to make things inconsistent. Why do we refer to it as AI? Yes, technically this is machine learning. AI is kind of like a catch-all term for everything within machine learning, but no, this is not ChatGPT or artificial general intelligence or anything like that.
And Ryan, how much data is going into the model on a monthly basis?
So we collect over 3 billion unique points as data, as we call them, a month for each individual location in the country. That of course varies because you don't want to use population growth in Maine to predict rent growth in South Texas.
Thanks. So Evan asked a question. Phil, you can answer. How does Multilytics affect investment purchases? How often have you missed good investments due to the model? I'm assuming it means Multilytics.
Yeah, so the first question there with regards to just the forecast. So obviously, I think, as Dave mentioned earlier, putting a rent forecast into a model, especially given the first year really matters as rents compound. Obviously, because if you go down the first year, you have to make up that rent loss, and we all know over time, it's just more growth you need to get back to that rent for your NOI that you're capitalizing at the end to make the investment work. I don't think we've necessarily, again, it goes back to the price you pay right at the beginning. Like, I don't think we necessarily have missed a deal because of the rent forecast, because there's more than just the rent that goes into a deal. It's about the location, the basis you're paying, all kinds of different variables. So I would say we haven't missed a deal per se. And then the second part of the question, what was the second part, Dave? Can you remind me?
Have you missed good investments due to the Multilytics model being incorrect? I think is the second.
To that question, no, I don't believe we have missed an investment to date because it was quote unquote incorrect. Like Dave mentioned earlier, when we're looking at deals, it begins with the price or your total cost. And I think we've talked about this on a lot of other webinars, but we don't really underwrite any rent growth in our development deals for the first, call it 16 to 20 months, depending on the deal itself. So we're always pretty hedged, relatively speaking, of where our rents are ending relative to what we think they'll end. So I think that's a big differentiator for us. So I would say no, we haven't. But Dave, if you have something else to add that.
Well, this kind of segues into the next question, which is anonymous. If the deal officer likes a deal, but Multilytics isn't seeing the same rent growth at that address, again, huge distinction. We go down to the address level, no one else does. Not only with starting rent, but future rent. And let me digress a little bit, Ryan, because this isn't one model, number one. Can you talk about how many models it really is and how it's selecting to solve a problem? And there's atemporal and there's temporal. I think people should at least hear it.
Sure. So we don't just have one giant model sitting somewhere making all of these predictions. Yes, we have a general model, and then we, for each area in the country, adjust that and backtest it for the best combination. And that tests over thousands of models, and Zillow spoke about how to do something similar. And then beyond that, we don't just look at time series modeling. We have atemporal models as well that select areas for high growth. And usually what we'll find is areas that have a good base prediction from the model we've been talking about today, line up with where we think there'll be high growth in the long term for the atemporal model. And what we'll generally look for is the two models to align, because again, we're very cognizant that this is not an oracle, it's a tool, and we try to use it as such.
So what I would ask Phil, this is a great question. From my perspective, there isn't a lot of disagreement between the deal officer and Multilytics at the deals that are presented at committee. However, the deals that are presented at committee might be, 2 to 3 deals get presented a week. So over the course of a year, you're talking about 100 to 150 deals a year. That's common, pref, development, et cetera. It's not showing me the 1,000 deals that never made it to committee, right? So like Phil, the question to you is, as a deal officer, you're using Multilytics not only to look at the areas of the city you want to invest your time in to look for deals, and then my guess is you're looking at your own experience and feel and relating it to Multilytics in order to vet those deals before they get to committee, right? And I think that's what I don't see that's probably happening. Yeah,
no, that's a good point, Dave. Yeah, I mean, Multilytics can go both ways, right? There's areas in Dallas where, you might go on Multilytics, our platform internally, and super bullish rent growth. And when you go drive it or talk to people locally or go put yourself in that area, you might scratch your head and, that's a time where you're like, am I missing something? Or vice versa. You might think an area is super good and it's not, on paper is good. Then again, vice versa, you're like, well, is there something I'm not seeing? And then there's other nuances to that question you just asked, Dave, about, fighting for something maybe that I think is better than what Multilytics puts out. There's always an element locally that a machine's not going to know. For instance, high barrier to entry. Maybe someone puts a moratorium, you can't build anymore. Maybe water's an issue. That's a huge issue down in Austin. There's only so many, capacity for water. Some municipalities, you can't even get water for 2 years. Okay, well, that's going to really limit development. There's like these little nuances that, that's little things that because you're part of the market and you understand and have a pulse where the machine might not know that. So yes, there are times where, I will go to bat or others with information that is known where we think it could be above what's being forecasted.
All right, we're getting close to the end. RH in the chat asked about the recording. We're going to have the recording and the full report possibly tomorrow, but certainly Friday, available to everyone who registered. So you'll receive it. Thanks for joining us. Greg, thanks you for your question as well. I'll answer this one. This is very logical. He says if we were seeing through Multilytics 15 to 25% rent growth in 21, why wouldn't we have started buying buildings direct at that point? The answer, Greg, is back to price versus growth. So two things were happening. One, yes, there was a lot of growth, but also price was literally jumping by 5-10% a month. And we were watching stuff trade 30-40% above replacement cost. Normally it trades within replacement cost. And remember, you're buying a long-term liquid asset. So you might get rent growth, but what do you get long-term? And what's your average CAGR look like? And then, so like all those things were consideration. And then the other was, this was a brand new model. Back to Ryan, back testing again and again and again, because he's showing us 20-25%. Historically, it's 3%. So there was an element of, gee, let's see if this model is correct. Let's not go make, $50 million decisions based on brand new machine learning, right? So it was both of those things. And what we chose to do was continue to invest, but do it in different ways. I think we've been proven to be right in that assessment. I think you're going to see that our largest outperformance to date will be in the next years to come, because you don't get to unmake those decisions, right? If you bought 2021 peak pricing, what are you going to do? So you're right, rents did go up 20%, but at the price you paid, they need you to go up more, and they're not going to, right? So the people that bought into momentum, it worked really well for 6 to 12 months, and it's not working so well anymore. We answered this. Another question from Doug. How many sources are we using to collect rent values in the model?
So for rent specifically, we have dozens of sources, just for rent alone. I don't believe I'm allowed to list them all on this call, just because we don't want to expose any of our providers. But these are like common third-party providers many multifamily firms use, and we're scraping public websites people typically look at for rents. So I'm sure you can guess where those are coming from.
Question from Enrique: why do we focus on Class A properties versus Class B or C? Enrique, it's because that's what we invest in. This is a tool for us. We own or develop Class A or A- properties. So, if we ever wanted to license this, we would have to combine it to everything, but that's not, it's for us. It's our proprietary software. I hope I pronounced this right, Prima. Thanks for your question. What's your opinion on buying direct long-term Class A assets? Our opinion is, and I've tried to be consistent about this, we would much rather develop to own long-term, and that's what we do in Income Plus. We develop so that we can get that 30 to 40%. Another way of thinking about it is, we're building for $250,000 a door instead of buying for $350,000 a door. And we believe that's both risk mitigation, because if property value is correct, we're still going to make money. We're not paying full price. We're paying 30 to 40% below full price. But we do want to build great assets in growing cities and neighborhoods that are strong, because we know we're going to own them for long periods of time. So we love owning long-term multifamily real estate. We're just getting there a different way. If replacement cost went all the way back down to flat, meaning I could buy replacement cost, great assets, or even below, and I know that sounds counterintuitive, but it does happen, then my opinion on whether you develop or buy direct would change. So we're not married to a strategy. We're constantly monitoring the risk return on different strategies within multifamily. Right now, I still would develop over buying, but it's changing. It's less of a spread as it was 12 months ago. And it's heading in the direction of, in the next few quarters, maybe you will start thinking about buying. And I spoke to that earlier. Thank you for your question. Jeffrey has a question. Are we bullish on BFR? What about age restricted over 55? I mean, these are great questions. And Phil, you should speak to this because you're very involved in both. So, please answer that.
Yeah, so to answer the first part, yes, Origin remains bullish on BFR specifically. As I think everyone's aware, just the affordability of buying a house has become a little more unattainable for most. So obviously a BFR, fills that void for a lot of families out there that want, to live in a house and not necessarily an apartment community with their family or others. So yes, Origin is bullish on BFR long term. And then the second one, the 55 plus, we are bullish on that as well. Really, location matters a lot for those, is what we found. And having the right amenities in place or close by really drives a lot of those communities. But yes, we're actively searching for 55 plus that makes sense in the right locations, and again at the right price.
Here's an anonymous question. Can you talk about the methodology used to forecast how far negative rent growth will be in the next 2 years and how quickly that rent growth bounces? Ryan, you can answer this, and I think you should probably speak to the exceptionally important variable, which is housing per capita and how supply is both monitored and affects what this question is driving at.
Sure. So fundamentally, we can look at rent growth through the lens of units per capita, which is the number of units available to the number of renters, and rent affordability ratio, so how much of your income is going to rent. And when we look at that for many of Origin markets, we believe there will be significant income growth coupled with population growth in the long term, and this leads to units per capita normalizing fairly quickly. And when you have that combined with higher incomes, generally you see higher rent growth. Beyond that, if we look historically, and we have long-running historic data back to the early 1900s for certain markets in the US, what we typically see is bouts of negative rent growth are followed by higher than average or above average rent growth, which gets you to a CAGR of about 3% in a 5-year average. So I think this fits well with what the historic data tells us is likely to happen.
Yeah, and I'm not going to say anything different. It's just there's a lot of supply hitting the market in the next 12 months, and that everywhere, and that has to be absorbed. We're underhoused as a country, but there's a lot of supply coming, and we'll remain underhoused, but in the next year there's a lot to absorb, and then it normalizes. And we're also, and you think about what's happened, the Fed takes interest rates to zero, and there's a lot of development. I mean, when you borrow it essentially, sub 3% on a development, that's fuel. So a lot of units are built in 2020, 2021. It takes about 2.5 years to build. Well, that means they're all hitting right now, right? And they're going to hit now in the next 12 months, and it's going to put downward pressure on rents, but then it renormalizes, and we have population growth, and in particular in our markets, to Ryan's point, more population growth. And so it can turn around faster. It's a very healthy asset class we're in, but it had 2 problems. One, it was overvalued. We never should have had 30 multiples on multi-housing. It makes no sense. We don't grow high enough to support those multiples. That's been de-risked somewhat. Now we're in kind of the low to mid 20s, right? The other problem was there was just too much supply that broke ground in the last, 2020, 2021, 2022. That's to work through. And it will. And I can tell you it already is, because there's very, very little new development that's happening. It's just, lenders have pulled back, margins have compressed, there's not a lot of deals happening, which means there won't be a lot of supply in 24, 25, 26. It renormalizes back the other way. We're kind of left with a worse housing problem going forward. But in 23, you won't experience that. You'll only see the supply. Okay, I believe that's it, unless there's a new question. Let me see. Oh, maybe you can answer this, Phil. Last question, and I apologize we didn't get to your question, but there were a lot. David asked, can Multilytics be modified, or Ryan, you can answer this, to apply to other commercial real estate asset classes like industrial?
We'll start answering this. The short answer is yes, it can be. But the longer answer is our models will work for other asset classes. It's just we have to feel confident in the data we're using to feel good about that forecast, is how I'll put it.
Yeah. Anything to add, Ryan?
No, I think that's fair.
Okay. It's designed for multifamily. It's all we do. So it's designed for that. It probably could be modified, but it would take lots of time. It's not something that'd be that easy, but probably possible. Thank you for your time. I really think this was a great presentation. I've enjoyed working with Phil and Ryan throughout, but also on this webinar. If you have questions that weren't answered, you can email me at david@origininvestments.com. I'll either answer it or forward it on to Phil and Ryan if I can't answer it. Either way, we want to be transparent and accessible. And this is really important work. We'll continue to invest in it, and we're going to continue to publish what we believe. And, just to summarize, we're the only group that I'm aware of that's predicting negative rent growth for the following year. And it's completely differentiates us from anyone else out there. So we'll keep you apprised. And if you're an investment partner, thank you for partnering with us. We'll talk to you soon. Bye-bye.